For the first part of this call, let me remind you that all participants will be in a listen-only mode. Afterwards, there will be a question and answer session. As a reminder, this conference call is being recorded. Madam, sir, please go ahead.
Good morning, ladies and gentlemen. I am Karel van den Bussen, Head of Investor Relations for Barco. Welcome to this conference call on the results of the first half 2020. And indeed today with me, our CEO, Mr. Jan de Witte, and our CFO, Mrs. Anne de Stender. Both Jan and Anne will present and will provide some extra color on the first half results. And we will do so following the first half earnings presentation. The presentation has been made available on our investor portal on barco.com earlier this morning, and also via a link sent to you on Bookcast. Following the presentation, we foresee some time for Q&A as well. And that's it for the introduction. Let's kick it off here. Jan, the floor is yours.
Thank you, Carl, and I suggest we start on page 4. Good morning to... Now, when we last had an analyst call, it was mid-April, we gave you an indication of how Barco business was being touched and would be impacted by COVID. And I would say 3 months later that things largely played out as we had assumed and projected at that time, be it with the top line that is a couple of points weaker than projected. And this relates to the significant impact in the second quarter in our entertainment business and our enterprise business, specifically with a very significant drop in the months of April and May, though we saw first signs of recovery as of the month of June. Our healthcare business has been holding strong throughout the first half, and this overall impact of COVID on our mix of businesses brought the top line for the group for the first half down with a decline of minus 18%. Now, thanks to decisive actions and on cost, we brought indirect costs down by 15% year over year. And as such, we were able to keep our EBITDA margin at around 10%. We did see working capital peak as we had been driving supply of parts in the month of February and March to secure our factory operations, to then see the market for finished products in the Western world drop very steeply in early April, leaving us with both higher than normal components as well as finished good inventories. Now, in parallel to running the numbers, we had our leadership team and all of our Barco colleagues engaged to navigate this crisis. We kept our employees safe while ensuring short and long-term business continuity. Over the second quarter, we also saw clear business impacts and made choices, but we also see our midterm and long-term growth opportunities remaining intact, being that COVID injected a clear delay, a clear gap in market development and roadmaps for our business units. If you flip to page 5, but if we look back to the second quarter, then the grid on page 5 that we showed you mid-April turned out to be directionally correct. In entertainment, we did see the expected material negative impact in cinema replacement, as well as in our events business come true. Also, the medium negative impact in new cinema installs and fixed installs in our Pro AV business came through, and those have their own budget logic and benefited as of May from the gradual unlocking of countries and museum-type settings. But altogether, it led to a 44% drop in top line for our entertainment business in the second quarter. In enterprise, which we called 3 months ago with a medium negative outlook, we saw a very significant drop in April and May again, linked to the lockdowns of corporates, of businesses, leading to 48% year-over-year drop. So specifically here, we also saw a clear improvement from April to May, and then from May to June, as corporates and businesses came out of their lockdowns in many of our geographies. And we expect this improvement trend to continue. Then on healthcare, as we also saw mid-April, healthcare proved to be the strongholder for the business, with plus 5% growth, driven by strong diagnostic business that to some extent benefited from COVID, and sustained growth in our surgical business that did feel some headwinds here during the second quarter, as operating rooms being put on non-active as a result of elective surgeries that were pushed out in time. As I flagged also in mid-April, our supply chain continued to show the agility to deal with this complex world and continue to supply where we had markets, be it with higher transportation costs, which we saw reflected in the gross margin, and with working capital increasing as we could not build down parts inventories fast enough. If you look at page 6, has been a quarter of proactive, agile changes. We made changes in our organization and operations, both physically as well as mentally, to keep our people safe and productive during their teleworking days. We also focused on business continuity in our markets and for our customers during this crisis. And also, we ensured we kept making progress on strategic projects and initiatives that we know will secure our leadership position in our markets in a post-COVID world. On the cost side, we were proactive and decisive in leveraging different mechanisms across the geographies where we operate to bring our costs down and be as much as possible in line with how we saw top line come down. All of this with the objective to protect our EBITDA margin and our business reserves. We froze discretionary spending, we leveraged temporary unemployment mechanisms, we pushed out lower priority projects and investments, and this crisis was also the right time to execute on the outsourcing of our LCM, our liquid crystal modules component, which is part of Unici. We decided to outsource that to an OEM in Asia, which gives us access to a step change lower product cost. And this allowed us to close down our Taiwan factory. Overall, we focused on our cash with a lot of focus on receivables and also inventories. Though here, the sudden lockdown and drop in the Western markets after we had pushed hard to get part supply up and running resulted in a spike, a peak in our inventory. If we switch to page 7, we saw sales for the first half showing negative growth in the range of 15 to 20% down year over year, with Americas a bit better than others as they started with a stronger first quarter. Both in EMEA and Americas, we saw a good start in the first quarter. In the second quarter, we clearly saw the cinema renewal wave stall, as well as ClickShare and control rooms that showed significant drops linked to corporates closing their doors and halting their projects. Diagnostic imaging showed again strong resilience in a market that needed imaging technology to fight COVID. In APAC, we saw this stalling of the market a bit earlier, but also saw some activity like our Pro AV fixed installs come back a bit earlier than in the Western market. Overall, while we saw customers push out existing orders or delay decisions, often because they were not able to be in the office to transact, we did see no material cancellation of orders. So it's mainly a pushing out of the order book, not a cancellation of orders. And let me here hand it to Anne to take us deeper into.
We are on page 8. with the overview of the financial highlight figures. Not really used to see that kind of, I would say, comparison, whereby in the previous period we more saw in comparison with the previous period more green, and now we are more in the red. But likewise, where we worked on to be a more resilient company in previous years, and also starting with a company when you go into such a pandemic that has a good balance sheet structure, really helped us also in this period to get through it. Orders and sales, so down compared to last year, orders 25% down, sales 18% down. We did indeed see month over month first recovery and positive signs as of June. So this is again hopeful. And also if we look to the order book, we landed at 370 million, which is essentially the same level as we ended last year with. It is 8% down year over year. But if we look to our order book and the orders, we did not see real material cancellation. So it is really a push out of different projects to later, but not lost. Gross profit margin, OPEX, both worked on this heavily and took decisive measures, primarily, of course, as of the second quarter, which yielded, and in that sense, could contain our gross profit margin. It is down 1.1 percentage points versus last year, but quite solid still. Higher transport costs had a really big impact here, kind of all fighting for the same transport lines, which were also not that obvious during those months, had an impact on gross profit margin, and also the mix effect. Primarily the lower sales of our click shares had the most important impact on gross profit margins. But overall, if you look to the divisional results, you will see there that this has been quite contained. OPEX we adjusted downwards year over year 15% across the company and also across fixed and variable costs. So discretionary spending cuts, adjusted activity levels in line with top line drop, etc., etc. So with that, landing and containing the impact of the hit of the top line with cost containment measures to our EBITDA, and landing there at 10% EBITDA margin, down 3.6 percentage points year over year. And as Jan already kind of flagged, free cash flow, we are at a peak moment at this time, impacting our free cash flow, coming to that back in a couple of slides with more details. Likewise on net income, I'll come back. Moving over to slide 9, the new pattern as what you have seen in previous times. Currency didn't really play a little positive, but for the rest actually it has not kept us awake in this first semester as such. The big drop is on, and the big red bar as such is on sales, excluding FX impact, minus 19%. Gross profit, slightly red bar, but contains this impact, and then the OPEX down, excluding FX here, minus 16%, has to a good part been able to mitigate the impacts of the drop in top line on profitability. The other results, including our share in the Barco CFG result, which has been a loss in the first half. This is our joint venture in cinema in China. And then we also took some provisions on bad debts. It's smaller numbers, but adding together to an impact, likewise on a couple of other provisions. And so with that, landing at the 10% of sales. You see here, and we added this now here for the first time in this visual, the breakup of per division, and also there, it's quite a different pattern as you would have expected, or if you compare it at least with previous periods. And needless to say that we have healthcare who has not been impacted, or to the contrary, positively by this COVID time. On slide 10, depreciations and amortizations essentially flat. We took an impairment and restructuring cost. This is primarily impairment, so non-cash, relating to the announced closing of our factory in Taiwan and a decision to outsource our Unici LCM to an external supplier. We will work on that in the second semester, gradually to do that transfer. But as we announced this and decided it, we have taken this impairment cost into our P&L for an amount of 8 million. Income taxes are at the same effective tax rate as last year. And then one maybe on the results in the share of associates or minority interest, you can also call it. This is a minority interest on the profits in Semionic for the first half, landing with that at a net income of 10.4 million and an earnings per share of 0.12 calculated here after the impact of the split. So for the first half, not good, landing at minus 51. Gross operating cash flow 36 million. So this is EBITDA, but then that's after the payout of the Fit to Lead also layoff provisions of 4 million as planned, and they're on schedule. Working capital high, peak high at this moment at about 11% of sales. Main part in this is the inventory. So as indeed the markets in Asia started to close down as of February, we did everything to contain that we could secure continuity in our production, continuity in supply chain of incoming goods, which we succeeded well, so that we could keep on delivering in time all customers. We then braked on purchases when we saw the different lockdowns, but there is a time lag effect between your orders, which you still have put, and then incoming goods. You then brake on your trade payables, so you see in the free cash flow, inventory is still up, not yet down, and then accounts payable down as we continued to pay our suppliers in time. So we did not do any specific actions in there and kept there up to our, call it promises. DSOs are at 82 days, which is, we have to wait 30 days longer on average or 1 month to get our money in. Mainly linked, the bigger impact here to entertainment and cinema, where we actually proactively also reached out to our customers and have payment plans with several of them. Money is still coming in, so in that sense they are following their payment plans, but working together there with the customers to get that all well managed, I would say, together and have this done better again by the end of the year. So these three impacts have caused that we at this midpoint now or at the peak of our working capital. We are still net cash 223 million. The difference versus year-over-year is of course the negative free cash flow. The dividend we paid out on the results of 2019 and an extra investment with it in Unilumin. ROCE we land at 16%. With that, I conclude the overview of the more figures part and give it back to
the first half and how we see this translate to the second half. Yeah, of course, as far as we can predict how COVID and specifically unlockings and lockdowns may play out for the rest of the year. So starting on page cinema. Cinemas pretty much across the world went into lockdown. Major movie releases were pushed out to the second half and beyond. And our customers have been managing their lack of income and lack of cash inflow very narrowly, which translated into push out of projector replacement projects, which we saw pretty much come to a standstill in the second quarter. Expansion opportunities, new builds of new cinemas in specific emerging markets, and like the Middle East, got some delays, but saw a lighter impact as a result of COVID. One of our competitors in cinema exited the market. For us, not unexpectedly, but it definitely towards the coming years creates opportunity for share capture in the market. In the venues and hospitality side, again, in the first half, we saw the events sector being significantly hit with their events being cancelled and orders being pushed out to later in the year. On the Pro AV, the fixed installs segment, we saw a softer top line, but also showing more resilience, where the lockdowns again resulted in lower activity but no cancellations of order. Also in China, which went faster into the lockdown, came faster out of the lockdown, we saw that translated into early recovery of the Pro AV fixed install segments already as of the April period. Simulation proved to be very resilient with projects, shifts, but also a stronger demand for real scale simulators. Overall, in entertainment, we saw our gross profit margins being quite stable, but we saw as a translation of the volume impact and the negative fixed cost leverage, we saw significant impact on the EBITDA as well as the EBITDA margin. If you look now at the second half, what we see happening in cinema is that theaters are globally reopening in the June-August timeframe. We see that in Europe. We see that in the Americas. This morning, the Chinese National Film Administration decided to reopen the Chinese cinemas as of July 20. Okay, so cinemas are reopening as we speak. There's of course the question on the movie slate and a little bit the chicken egg situation between the theaters and the releases of the new movies. So we also know that our cinema customers are going to focus on cash in the first months after they reopen, shore up their balance sheets again. So we expect this to reactivate the replacement opportunity near the end of the year. Replacement opportunity is going to trail by a couple of months the reopening of the cinemas. In terms of the cinema expansion, the news build here, we expect and see the beginning of recovery. The budgets are there. This is not linked to the movie slate, so we see those projects pick up again as people can get back to their jobs. For the venues and hospitality division, here events will only slowly pick up after the summer. A lot of the big ones have been cancelled, so slow pickup there. Pro AV segment showing again more resilience and start to see recovery in line with easing up of the constraints. We see that definitely in museum type settings and museum type events. And then simulation, we continue to see steady performance in the second half for that business unit that already did well in the first half. Okay, so overall, I would say after the second quarter lockdowns, we're expecting a slow comeback in cinema replacement market and events, mainly towards the fourth quarter, but an earlier pickup again for the cinema expansion projects and the Pro AV fixed installs. But then I'm starting with corporate, which is primarily the ClickShare family of products. We saw in the first half a clear softness as of mid-end March, and during the lockdown. Pretty much because companies shut their doors, people went home, worked from home. We also saw to see the first recovery in May and June as people were coming back to work, and many companies are starting to operate in a hybrid mode. People in the office, part of the people working from home. We saw this start in EMEA with a mix of pickup in our ClickShare presentation as well as in our ClickShare conference product. During COVID, and very much at this point in time, we were seeding the market. We're stepping up our marketing to promote the newly launched ClickShare conference, a product which has been very well received by the users, the customers, the channel, as a product that in this world of stepped up video conferencing activity, and video conferencing with mix of people in a meeting room, mix of people working from home, this is a big enabler to improve the quality of this type of meetings. On the control room side, the market as such is resilient. This is about critical infrastructure, crisis management infrastructure. Some of our meeting rooms were used as crisis center for COVID control. So there's a need for this type of technology. We did see projects go in slow motion as people could not access their sites to execute on those projects. We also saw the second quarter being better than the first quarter, despite COVID, and that was related, I would say, mainly to a weaker first quarter, where we saw some of the oil shock impact. On WeConnect, which is an incubator product that we launched broader in the market last year, virtual classroom proposition, which for many higher education, business schools and corporate education centers is a highly professional product to enable remote education. We've seen a significant uptake there and a very strong build-up of funnel and some great reference projects that we've landed and are installing ahead of the reopening of those institutions after the summer for the new school year. Also here in enterprise, gross profit margin remained stable, which again led to an EBITDA margin mainly going down because of volume effect, and EBITDA margin going down because of fixed cost leverage effect. Looking into the second half, we expect both ClickShare presentation and ClickShare conference to rebound. We've seen the first signs of that in the month of June. In fact, we're on a track where the month of May was better than April, June was better than May. Outlook for July looks better than June. So we see this market steadily come back. And both for ClickShare presentation as well as conference, where for ClickShare conference, we're still launching this product. We are stepping up our marketing to make this product known in the market, especially the market that's now larger than we assumed a year back with the acceleration of video conferencing. Control rooms in the second half, we see the market opportunity confirmed, and we expect that to translate in a further pickup in line with market recovery. For these type of projects, access to the sites is important. We've seen the negative effects of that during lockdowns. This is one area where we're also cautious with how future lockdowns may impact further delays or not in this segment. So overall for enterprise, I would say we saw the declines across all regions in both the corporate as well as the control rooms segment, with early signs of recovery over the month of June, linked to the unlocking, the back to office movements in the economies. And we further see this business unit pick up in line with how economic activity in the geographies will be picking up. Moving to page, very solid growth in the sales, both driven by OEMs, medtech OEMs that use our technology, stepping up their capacity, as well as opportunity for home reading radiology, for which we had the right product at the right time. In surgical, remains solid, definitely on orders growth over the first half. Here sales growth was positive, though more modest in the first half, with elective surgeries being postponed, which resulted in delays in deployments in surgery. Demetra, our new product for skin cancer, which we launched in Belgium last year and started to launch in Germany. We're picking that up as we speak, post-COVID. We did delay our launch in the Americas, which was planned for March. So we kept the money, and we're now going to spend that money in terms of launching in the market in the fourth quarter normally of this year. Overall financials for the first half, very good operating leverage on the higher sales, together with very good discipline that we kept on OPEX, bringing both the EBITDA margin as the EBITDA absolute to a significantly improved levels, while we still continue to invest in growth initiatives and in our In China for China program. For the second half, we expect healthcare to continue on this momentum. Diagnostics is a steady growth business, has now shown to be able to do this also in very tough times. Surgery, here we expect an uptake in the second half, partial transition of first half push-outs, and a reflection of the stronger order take over the first half. And then China, a very important focal point in our healthcare business, continues to steady deliver on the growth and the growth investments that we have made there. So I hope that this gave a bit of color as to what drove the second quarter and what we're trending towards in the second half over the second quarter. Now, like we did in April, we've tried to summarize this in a schematic which you can, and the impact we expect for the full year 20. Impact related to the growth momentum which we had at the beginning of the year. This is still very much in line with what we showed you in April. The last column then shows how we see the third quarter compared to the second quarter of this year. With the plus sign meaning that we see the third quarter better, increased volume versus the second quarter, and the squiggle sign meaning that we see third quarter volumes in line with the second quarter. Okay, so the highlights, if you look again at cinema, we still see the third quarter in line with the second quarter. And that's the slowness on the restart or the lagging of the restart of the replacement market, holding back the better dynamic that we see on the new builds and the market expansions. For venues and hospitality, we see the third quarter better than the second quarter, mainly driven by the fixed installs picking up again as a result of the gradual unlocking of the entertainment and some events. Simulation, we did well in the second quarter. We continue to do well in the third quarter. In enterprise, we see us doing better in the third quarter than the second quarter, with ClickShare picking up speed again, and that's both ClickShare presentation as well as the launching, the pickup from zero to a new business in ClickShare conference. Control rooms, we see again here a third quarter in line with the second quarter, which, as I said, was a fairly good second quarter, better than the first quarter. And then healthcare, we continue solid year-over-year growth that we saw in the first half. We're continuing to do that in the diagnostic, and then surgery steadily picking up. Maybe one word on navigation. A lot of uncertainty remains for us, and I trust for all of you on the phone and many of my colleague CEOs across the world. There's the uncertainty around the shape of the recession, which is not clear, though I think there's consensus that it will not be a V-shape. But also the re-emerging of outbreaks and how authorities will react with limited or broad lockdowns, where specifically in the entertainment space, I think there's higher sensitivity to government decisions. So besides gaining insights in our markets and following up government decisions as much as possible, we're also focusing on business resilience, rapid reaction to ensure we keep Barco healthy to be and remain in a strong position for when the recovery would restart in earnest. We're containing our costs and we're redeploying resources from low activity areas to growth areas, like our healthcare business. But overall, we're trying to set up for a 2021 with a healthy level of conservatism. Therefore, we're working out the business plan for 21, where we're going to keep our indirect cost levels at 2019 levels. That puts us in a position to do well in 2021. If I then on page 19 with the outlook. And while in this presentation we've tried to give you as much insight in the market dynamics that we see and what we expect to see, it's also a given that there is still a lot of uncertainty and unknowns, the shape of the recession and the risk of repeat lockdowns. And therefore, at this point, we're not reinstating guidance for the year. We do expect that the second quarter we've seen the worst, the weakest of the year. And expect that in the third quarter, the fourth quarter, we're going to see a steady quarter-to-quarter improvement between now and the end of the year. As I said, for 2021, preparing for 2021, assessing this quarterly progression, we are planning a budget, want to work a budget where with good caution, we plan for a 2021 cost base, which is going to look like 2019 cost base at group level, at business unit level. We'll make the redeployments of the OPEX as needed. So what does this mean for second half profitability? We're currently running at cost levels under 2019 as a result of the many cost actions, cost containment, including temporary unemployment. This has allowed us to be at 10% EBITDA for the first half, despite a very significant sales drop. Over the second half, we're going to remain cautious and disciplined in how we relax these cost actions in alignment with how over the third and the fourth quarter we expect this quarter-to-quarter improvement. We've shown we can do this over the first half, and our aspiration for the second half is to ensure we deliver a second half performance at first half level or better. But we also know again that the way to our top line will develop, will be a very important driver in our profitability. As you've seen in that walk, EBITDA walk that Anne showed, the biggest driver in our EBITDA and EBITDA margin is how the top line will play out. And that's where over the next 2 quarters, we still have, let's say, more proof points to deliver to extrapolate towards a clear outlook there. So with that, I'm going to hand it back to Carl to manage the Q&A.
Thank you, Jan. The operator will explain you how that works. Just one householding rule. I will insist on a maximum of 2 questions at a time, and in case you have more questions, please queue again. Over to the operator.
Thank you. We will now begin our Q&A session. Ladies and gentlemen, if you wish to ask a question, you may press 01 on your telephone keypad. We have one first question from Mr. Matthias Manaut from Kepler Cheuvreux. Sir, please go ahead.
Yes, hello. Good morning. Can you hear me?
Yes, we hear you, Matthias. Good morning.
Yeah, good morning. 2 questions from my end. First, a more general question. Clearly, your balance sheet is in a good shape, and you are able to use your cash to put it at work, giving more support to your customers. If you look at how the competitive environment actually evolves, do you think this is for you is a differentiating impact, and will it lead to a bigger take of share, I would say, when the growth returns? And then a second question is actually on the cinema business. You recently announced a retrofit deal with Kinepolis. Can you maybe talk a little bit more about that offering? How are the dynamics in terms of margins versus the rest of the product portfolio in cinema? And do you think that given the current, I would say, adverse or challenging conditions for the cinema chains, there is a risk of people actually not longer replacing but using these retrofit offerings? Thank you.
Okay, Matthias, the first question on balance sheet and how to play that out in a competitive environment will be addressed by Jan.
Yeah, I'll take the second to that.
All right.
So question on the balance sheet. Yes, balance sheet is in good shape. We are using it with caution, of course. We're capable with some of our customers to, specifically in entertainment again, to work with them on payment plans. We've also allowed for customers that where the projectors are not running to extend their warranty by 3 months. It really caters to the needs of those customers. It's buying us a lot of loyalty and goodwill. It also, our balance sheet puts us in a position to further offer OPEX type propositions. I think you may have heard us in the past 2 years talk about that. I mean, we want more OPEX. In those times, I said customers want to talk OPEX, but they still buy CAPEX. Because of COVID, there's definitely more interest in OPEX type propositions. Our balance sheet allows us to do that. Of course, we're only going to do it with players that we are have a long-term viability. The question on the retrofit also relates a little bit to that. Okay, so why do customers want to go with the retrofit? It's a laser retrofit. Okay, so it gives them the better light quality, but it also gives them the lower operating cost. Energy consumption is about half for a laser light source as compared to a lamp light source. So that's why installing laser retrofits is a productivity move by the cinemas. It's also a move because we offer it as an OPEX type model. It's a move for them to have a different way of financing. Now, is laser retrofits gonna avoid replacement of projectors? The answer is not really. I mean, in the install base in the market, not every projector can be retrofitted. Second, a projector that has been running for 9 years and is starting to fall apart, a retrofit is not going to fix that issue. And then the other is the next generation. The current generation of new projectors is 4K resolution. old projectors are 2K resolution. A laser retrofit does not fix 2K into 4K. And especially, I think cinemas these days understand very well that they need to deliver a differentiated experience to the consumer, different, better than the 4K resolution that they see on their TV back home. Laser retrofit is going to help a certain segment to upgrade at the time where they may not have the capability to upgrade, but is not replacing the replacement wave of the 80 to 100,000 projectors that we've been talking about.
Yeah, thank you, Jan. Thank you, Matthias, for the questions. Over to the next question.
Next question is from Mr. Guy Sips from KBC Securities. Sir, please go ahead.
Yes, thank you. First question is a follow-up question on the first one. Can you give us an idea of the margins on the retrofit? Are they in line with the other products? And the second question is on ClickShare. So the downturn we saw is partly by the G-curve we saw from clients waiting for the new ClickShare conferencing system, and then as well as the COVID-19. Can you elaborate a little bit on these two elements? What do you expect that the first element was the impact? But what was the impact of the first element of these postponements of clients? Thank you.
Yeah, Guy, I'll take the first question on margin. We don't disclose margins on sub-segment levels nor on product types. Let's say as a takeaway on entertainment, we share that gross profit margins have remained stable year over year, and as part of that, there is more lasers, there is a bit of retrofit in that deployment part as well. So on the next question, Jan,
let me take that. Question on ClickShare. So as I said, we've seen from April to May to June, we've seen this market come back, and we're definitely trying to jigger it. Both customers and even more our channel confirm that this is the product at this point. Now, interestingly, and that's probably going to answer your question the best, is out of if I look at the June numbers, 85% is still the old ClickShare presentation, which is to me reassuring. It means that the product that the market knows is still selling. Okay, while the product that we just launched, if we do our marketing job well, especially now in the post-COVID video conferencing world, has potential to continue or to pick up growth in addition to the growth that we see or the pickup that we see in the old ClickShare. Okay, so in terms of cannibalization, one versus the other, we do not really see that yet at this point in time.
Yeah, over to the next question.
Next question is from Mr. Christophe Béguin from Kempen. Sir, please go ahead.
Good morning, everyone. I have a question actually as well on the enterprise division and specifically on ClickShare. I had a call slightly with Kyle this morning, and you stated that if we look to the units sold, that we are quite similar at the level of 2018. If we then calculate, you give a split of the enterprise sales versus the corporate, then we arrive at 64 million for the corporate segment versus 59% in the first half year of 2018, which was 88 million. So we see a decent drop in the sales versus first half year of 18, but you have sold 10,000 units more. Can you elaborate a bit more on that?
Christophe, perhaps just clarifying on the question and on my remark there.
Yeah.
My comparison to first half 18 was actually the EBITDA margin of the enterprise division in 18 was actually at the same level as the EBITDA margin of enterprise now in the first half of 2020. So I did not disclose anything really on quantities shipped on ClickShare.
No, but the units are disclosed in the you give a jump from units at year end versus the units at the end of first half year in both first half year 18 and first half year of 20. So you see that you have sold 80,000 units this half year versus 70,000 units in the first half year of 2018.
Yeah, these are approximate numbers, indeed, how we, let's say, inform you or keep you informed on the growing install base of ClickShare. So a bit difficult to take conclusions from that. But in terms of ASP, we're pretty much still at the same level on ClickShare as we were at the end of last year. So around 1,000, a bit below 1,000 euros.
Definitely okay. ClickShare pricing has not changed.
Yeah, exactly.
I mean, there's always a bit of end quarter negotiation, but I mean, we're talking this is low single digit percentages if and when that happens.
Then I have a follow up on the same. Is then profitability on ClickShare coming down?
No, not really. So as we referred in the slide on enterprise, also gross profit margin on enterprise remains quite stable in the first half compared to a year ago. So while actually indeed volumes came down, gross profit margin stayed quite solid.
I think the key, and that's pretty much across all business units, our gross margins are holding up quite well. The biggest impact was transportation costs that in the past 2 months ate a chunk. So what you see happening, our EBITDA margin is negative operating leverage, which we've tackled to a large extent, but very tough to tackle a full 18% top line drop.
Yeah. Maybe then the last thing, can you confirm then that over the first half year of 20, that the EBITDA for the control room division was positive?
So we don't disclose on sub-segment levels the EBITDA margin for the first half. But let's say it was.
Was it absolutely positive? Was it profit making or loss making? Can you maybe just confirm that?
We stick to the statement that it was not better than last year, Christophe.
Okay. Thanks.
Thank you.
Next question is from Mr. Chris Keepers from Degroof Petercam. Sir, please go ahead.
Yes, good morning, and thank you for taking my questions. One is coming back to the optionality of the balance sheet. If you look indeed on the client side, you indeed can mitigate some things for them, which is interesting, of course, but would you also consider doing some interesting add-on purchases or perhaps larger ones in view of the market situation and what the optionality of that cash position could be? And then a second question would be on the outlook. If you look indeed on the 2021 cost-based guidance, would this then imply that this also indirectly is indication for both revenue and EBITDA evolution that it should not exceed materially the 2019 level? But I presume that you would repeat the 2022 outlook. Is that correct? Thank you.
Thank you, Chris, for these questions. Jan will take the first and Anne will take the second question.
So the short answer on the first part is yes. Already, I think, but more than a year ago, we said, look, we feel we're in a shape where we can start to use that balance sheet for M&A type deals. Even more in a tough environment. So yes, we are considering. Typically, it's more after the dust settles that the good opportunities come up. At this point, there's bad opportunities, companies that were in bad shape and got even in worse shape because of COVID. So, yeah, short answer is yes. Yeah, we are definitely exploring that.
The second question, we remain our ambition on the more mid-longer term to be and stay a profitable growth company. As to the impact of 21, and where we see actually, and yes, uncertainty on top lines, but there to really be also more on the cautious side, and in that respect towards our indirect costs. We see our quarters becoming better in this year, and in the fourth quarter then already kind of in line with 19 levels, which indicates that for 2021, we should get back at a kind of level top line wise of 2019 or better. Now, to be more, and that's more on the cautious side as to indirect costs, when we go into the planning phase, which we typically start over the summer, that's why we have set our target as let's not go for an indirect cost level which is higher than 2019. If we have more upticks or upsides seeing and coming on the top line, then we have the options to do more. That's certainly not the going in position, and that's where we put it straight internally in the company, and we also wanted to share that guidance with you. But then towards the years after, to sustain a profitable growth company, that we reconfirm.
Yeah, which is essentially what we said at the Capital Markets Day, right? We're a mid-plus single-digit growth company with a EBITDA outlook 14-17. That we took that very serious when we set it, and so our plans are working towards delivering on that outlook.
Excellent. Thank you.
Thank you, Anne and Jan. Ready for the next question?
Yes. Next question is from Mr. Mark Esseling from ING. Sir, please go ahead.
Yes, thank you. My first question is on ClickShare as well. You clearly missed some opportunity in the previous quarter. That's normal. But do you think that this will, when we see a recovery, will it be back to your normal growth levels in a while, or will there also be some kind of pent-up demand, stuff that was not being placed in the previous period that can be placed somewhere in the future? Maybe also they are taking into account that I'm really interested on the conference too, what your feedback is today. I mean, clearly in the past period there has been a lot of conferencing tools out there. Clearly they are different than your solution. But how much tangible proof do you have that you have the right solution and it's going to be the Barco product that's going to be used in a conference world? And my second question is on healthcare. It's clearly strong, but if you look at the dynamics of order intake even being stronger than the revenue trend that we saw in the first half, and we talked about that surgical imaging being pushed out a bit. Does it imply that the revenue growth that we've seen in the first half will accelerate going into the second half? And if it does, what does that mean for operational leverage? Thanks.
I'll leave the first question to Jan to give a bit of extra color on ClickShare and ClickShare conference.
So first on ClickShare presentation, the let's say the old ClickShare, which at the beginning of this year was not at the end of its growth curve yet. Growth got interrupted by COVID, and like I said, at least in the month of June, we started to see the pickup again. It's a bit early to extrapolate on that one data point, but do believe that the market for ClickShare presentation is there, and we see our resellers still looking at ClickShare as a product where after COVID they want to make money with. Okay. Everybody is having their focused list of things to go after recovery, and we see from our channel that ClickShare is part of that. The ClickShare conference that we launched as the next category to further either protect or accelerate our overall ClickShare growth franchise. When we launched it, we also communicated, look, there's one uncertainty, how is the one going to cannibalize the other? And that makes the difference between is ClickShare Conference going to accelerate our overall ClickShare growth, or is it going to sustain our ClickShare growth? The silver, the positive lining of COVID is that the market of conferencing tools, video conferencing tools being used has suddenly been accelerated by about 4 or 5 years. So that opens up the accessible market for ClickShare Conference broader than what we thought 6 months ago. The question is this the product that customers want? The answer is based on those first customers and the channel, okay? Because those are the ones that at the end of the day have the dollar signs in the eyes and make the distinction between a winner and non-winner. That conviction today is even stronger than it was 6 months ago when we did the pre-launches and the pre-communication of that. Question here again is, what's the speed at which people will get back to office? Okay, and then the second, even when people are back at the office, I mean CFOs all across the world are gonna keep an eye on OPEX spending, and that may be the second thing that influences the ramp-up curve. Other, maybe one element, one of our competitors is launching a somewhat comparable proposition 5 months after we're launching, copying pretty much our positioning, which I frankly welcome. Right? It's ClickShare Conference is a new category that we're creating. Did not exist anything like that before. So having one competitor to helps creating a category, to me is a positive sign. Okay? I don't want a dozen. A couple of competitors are very welcome to help create a new category.
Yeah. On the second question, Mark, on the healthcare. So the short answer is on a divisional level. Yes, we do expect the top line in the second half to exceed the top line of the first half. Opening up the hood a bit on the underlying segments, dynamics are expected to be slightly different. First half was really fueled by a strong performance in the diagnostic segment, with growth in surgical, but a bit slower than anticipated. Moving into the second half, we believe that the two segments will continue to deliver growth, but so let's say in a more balanced way, in a more equal way than in the first half. So I hope that addresses the question on healthcare.
Maybe because you're also quite impressive margin in the first half of the year because of cost control despite the growth. Is that something that should also then continue in the second half of the year?
We stay more cautious in the sense that in healthcare they also helped out on the across the board cost containment actions, and in that sense, as we go into the second semester or moving forward, the activities are called cost containment will be more business by business and less across the board. Because to also really help them out to ramp up on whatever projects they now kind of delayed a little bit.
Yeah. Okay, that's great. Thank you.
Engine, healthcare, the stable engine in 2020, so to speak. So there, I would say the guidance in terms of profitability remains pretty much aligned with what we said in the beginning of the year. Good. We're ready for the next question.
Next question is from Madame Manon Coulon from Erasmus Gestion. Madame, please go ahead.
Hello, I have two questions, if I may. First one on the net working capital. What should we expect going forward in H2? Should we expect, for instance, the stock to normalize? And the second question would be on gross margins. Can you detail a bit more between the impact of the bad mix and the transport? Can we think that the transport is just a one-off and it's going to normalize in H2? Thank you.
Thank you, Manon. Anne is ready to take your question.
Hi. On the net working capital, so we were now at a peak of 11% on sales, where in all of the previous years we were between 0 and 5%. So in that sense, we want to get back to the level more of 5%. Whether we will get there fully already by the end of the year, we will see. But that's certainly the figure where we more target towards. So in that sense, primarily the pushback on purchases, which we did actually, which then not yet reflected in a cost in a down on inventories, will come then in the second semester. So that primarily will have an impact on our lower working capital in the second half.
And the second on the question on gross margin.
Okay, I continue. So on gross profit margin, so a little down versus last year, 1.1 percentage points. Two main impacts there, three actually, one positive and two negatives. The one positive is, of course, it's fully cost containment on all more variable costs, which you could say is a more easy one, but also within a gross profit margin, there are quite some indirect cost part as well, which we put the brake on. And then, so that's to the positive and to the negative, extra transport costs. Year over year, that's about more than 6 million in the equation. And then the last part, the mix, and the most important one there is within enterprise or enterprise, taking it down actually and coming from the lower sales and click shares.
But the transportation cost impact is improving. But it's so still, we saw definitely a peak a couple of months ago when there was no planes flying and definitely no commercial. So that peaked. With commercial flights getting steadily, say normal, it will take a while, but as that improves, the price pressure starts to improve.
Year over year, though, in the second semester, we do see still a negative impact also there.
Okay, so the negative impact of 6 million in H1 should improve in H2, but it's not going to be zero negative impact.
Exactly.
Correct.
Okay, thank you.
Thank you. I see one more question.
Yes. We have one last question. Then Ms. Peter Taster from One Investment. Sir, please go ahead.
Hi, Anna. Thank you for taking the question. It's really a question around costs. I'm just wondering if you look at the use of short-term unemployment in H1 on direct and indirect costs, how you perceive, if you give some scale of that, and maybe how you perceive it unwinding as government programs start to share the cost with companies. And then related to that, thinking about a reshape of costs going forward on direct and indirect between the divisions. So, for example, within your goal of flat 21 versus 19, whether that you think you need to bring down cinema costs, for example, to afford the increase in enterprise support and ClickShare, just to give some sense of what you think you need to do on cost reshaping going forward. Thank you.
Yeah, great question, Peter. Thanks.
The temporary leveling down of employment will still kind of continue in the third quarter. But we are then gradually moving over from, instead of call it across the board, temporary unemployment to more specific actions within in the divisions. And then likewise on preparing towards 2021, rightfully, as you indicate, Peter, is that it will be more a cost down into entertainment with to the max internal redeployments towards the extra need of capacity, which is, for instance, healthcare is looking for. I can only confirm actually the statements which you included in your question.
Okay. And do you think there'd be a particular move both on direct and indirect costs, or primarily indirect costs to manage all this?
Primarily indirect costs. You do have that indirect cost as well. We also did in this first semester internal redeployment of direct people in the manufacturing, where we educated, trained people as there was lower activity in projection and towards healthcare. So that's more part of the usual business and operations actually. So yes, there it also happens more regular, I would say.
Well, on the direct cost, we have a high level of flexibility, and not since COVID. That I would say historically we've been able to tune our direct cost quite well with volume.
Yeah. Okay. And can you give any sense of the degree to which you used the temporary cost unemployment measures in H1? Just the benefit from that?
I think it's a material part, of course, of.
It's a material part, but it's not the most material part for sure. So in that sense, the most material part is really the discretionary spendings, all of travel, which has fallen down to zero. Then marketing spend, trade shows that doesn't go. Then being cautious on any marketing. Then projects which are pushed out. Consulting costs, the higher freezes. So this list which I just gave you is far more important than the temporary, but it does help. It does help, and it is not an immaterial amount for sure. But it's not that 1/3 or more than half is coming from unemployment measures.
Great. Okay, that's all helpful. Thank you very much.
Okay. Thank you.
Thank you, sir. Next question is from Mr. Sébastien Lemonnier from Innocap Gestion. Sir, please go ahead.
Hi, good morning. Hello, all. Just two quick questions. Just on Click and Share. So you mentioned that May was better than April, June better than May, and July better than June. Can you quantify a bit the kind of gradual, slow back to normal situation? And I don't know if it's too early to say, but shall we expect, as most of the big head office will get back to work by September, shall we maybe expect a more back to normal situation for Q4? And can you comment on the potential inventory built up from your dealer to get ready to install the equipment by September, October, when the people get back to work? So that's the first one. And the second one on the M&A, just to make sure I understand. So if I state your words like it's part of your agenda, but I know it's part of your agenda since several quarters. So does it mean the probability to see something is bigger today than it was maybe during your last communication, or is more or less the same? Thanks.
Okay. Thank you, Sebastian, and good morning to you as well. While we will not be able to open the full book on all your questions, I see that Jan is eager to respond to the first one.
So it's the first one is a tough question, Sebastian. In terms of do we know the trajectory for ClickShare? The honest answer is no. I know the past 3 months, where we, I mean, net, we're still very significantly under normal, but we saw the positive trend. I see the sellout dynamics for July. Now it's still early days in July. And by the way, when I talk about trends, I talk about sellout trends. Our resellers selling to end customers. So it's not our sell-in, where we sell to our channel. Sellout is the real dynamic in the market. So too early to really extrapolate those 1 or 2 months of pickup. In terms of our channel in inventory, if we look at channel in inventories today, which we manage carefully to not stuff the channel, then what we see is that the inventories are still primarily the ClickShare presentation, and there is some channel buildup needed in the ClickShare conference. That's where in the month of July, some of the acceleration would likely be coming from building up for ClickShare conference. Okay, on the second one, M&A, I captured his question. Is it more probable? I would say yes. Probability is higher. The cautiousness is the same. So it's not because there may be more targets that we're losing our rigor in understanding value creation and the real fit.
Okay, thanks. Take care all.
Thank you, sir. We have no other questions.
Okay, then I think we can conclude this session, the presentation and the Q&A session. Let me thank you all for participating to this call, and should you have any more questions coming up, you can of course reach out to me. Also the IR department remains open for business, and we're still there for another week before we move to some well-deserved holidays. Thank you all, and have a great day. Bye-bye.
Ladies and gentlemen,